Hey finance virtuosos! Welcome back. Today, we're talking about how to achieve financial freedom. But we're not just talking about any old method. We're going to break down a simple, 3-step paycheck routine that can set you on the path to financial independence. This is the Finance Virtuoso channel. If you're new here, hit subscribe and the notification bell for the best money tips and tricks. Now, before we jump in, let me paint a picture for you. Imagine coming home to find a stack of boxes at your doorstep. Sound familiar? In the reference I came across, one couple's record was 17 boxes in a single day. That's wild, right? But it's not uncommon in our consumer-driven world. So, why is it so hard for us to fight the urge to consume? Well, one theory suggests that deep down, we like making other people rich. Think about it. When we buy that new gadget or designer outfit, we're essentially helping some CEO build their next mansion or pushing a tech startup closer to that billion-dollar valuation. While we're busy making others rich, we're often neglecting our own financial health. Let me throw some scary stats at you. 1. 70% of Americans have less than $1,000 in savings. 2. The average American has $7,000 in credit card debt. 3. It's estimated that half of Americans over 55 will retire in poverty. These numbers are a wake-up call. But don't worry, that's where our 3-step paycheck routine comes in. Let's break it down. Step 1. Add friction to your spending. The first step in our paycheck routine is all about creating intentional barriers between you and your money. Why? Because in today's world, spending has become frictionless. We've gone from cash-only transactions that required physical effort to one-click purchases on our smartphones. Retailers and tech companies have worked hard to remove all friction points between us and spending our money. And while this convenience is great in many ways, it's also made it incredibly easy to overspend. So, what can we do? We need to intentionally add back some friction. Here are a few ideas. 1. Use cash for discretionary spending. When the cash is gone, your spending for the month is over. 2. Implement a 24-hour rule for online purchases. If you spot something you want, hold off on buying it for 24 hours. 3. Unsubscribe from marketing emails and unfollow brands on social media. 4. Delete shopping apps from your phone. 5. Keep your credit card in a drawer instead of your wallet. By adding these friction points, you're giving yourself time to think critically about each purchase. You're switching from reactive spending to proactive spending. Step 2. Automate your savings. Now that we've put the brakes on unnecessary spending, let's talk about Step 2, automating your savings. Remember those scary stats we mentioned earlier? Well, the best way to avoid becoming part of those statistics is to pay yourself first. And I don't mean treating yourself to a fancy dinner. I mean putting money aside for your future self. Here's how to do it. 1. Decide on a percentage of your paycheck to save. Even if it's just 5% to start, that's great. 2. Set up automatic transfers from your checking account to a savings account on payday. 3. Gradually increase your savings rate over time. Try bumping it up by 1% every few months. By automating this process, you're ensuring that saving happens before you have a chance to spend that money elsewhere. Step 3. Invest in appreciating assets. Alright, we've curbed our spending and we're consistently saving. Now comes the fun part, investing. This is where we shift our mindset from being consumers to being owners. Instead of buying stuff that loses value over time, we're going to buy assets that appreciate in value. Some of you might be thinking, the stock market is just for rich people, or isn't it too risky? Let's debunk these myths real quick. First off, you don't need to be rich to invest. You can start with as little as $5 these days. And as for risk, yes, the stock market can be volatile in the short term. But over the long haul, it has consistently gone up. Let me tell you a quick story about Joe. He started investing $500 a month in an S&P 500 index fund back in 2006. After the first year, he had about $6,500. Not bad, but not life-changing either. Then came the 2008 financial crisis, and at one point, he was actually losing money. But Joe stayed committed to the process. Fast forward to today, and Joe's balance is close to $200,000, after contributing just over $80,000 of his own money. That's the power of consistent investing in appreciating assets. So, how can you start investing? Here are some steps. 1. Open a brokerage account. Many online brokers offer commission-free trades now. 2. Start with low-cost index funds. These give you broad market exposure without the need to pick individual stocks. 3. Consider setting up automatic investments to coincide with your paydays. 4. Diversify your investments over time. As your portfolio grows, you might explore other asset classes like real estate investment trusts, REITs, or bonds. Remember, investing is a long-term game. Don't get discouraged by short-term market fluctuations. Stay the course, and over time, you'll likely see significant growth. Putting it all together. So, let's recap our 3-step paycheck routine for financial freedom. 1. Add friction to your spending. 2. Automate your savings. 3. Invest in appreciating assets. By following these steps consistently with each paycheck, you're setting yourself up for long-term financial success. You're saying no to mindless consumption and yes to ownership and wealth building. Now, I want to emphasize something important here. This isn't about becoming a miser or never enjoying your money. It's about being intentional with your spending and making sure you're taking care of your future self. You can still enjoy life and have nice things. The key is to find a balance that works for you. Also, remember that everyone's financial journey is different. Maybe you can only save 1% of your paycheck right now, or maybe you can save 30%. The exact numbers don't matter as much as the habit and the mindset shift. Lastly, don't get discouraged if you slip up sometimes. We're all human, and there will be times when we make impulse purchases or forget to save. What's crucial is to get back on track as quickly as possible. Financial freedom isn't defined by a specific amount of money in the bank. It's about having options. It's about being able to weather unexpected expenses without stress. It's about being able to retire comfortably. And ultimately, it's about being able to live life on your own terms. So, are you ready to start your journey to financial freedom? Remember, it all starts with your next paycheck. Add some friction to your spending, automate your savings, and start investing in appreciating assets. Your future self will thank you. That's it for today's video, folks. If you found this helpful, please give it a thumbs up and consider subscribing for more financial tips and tricks. And let me know in the comments, what's your biggest challenge when it comes to managing your money? I'd love to hear from you. Until next time, here's to your financial freedom.